Okay, so welcome to this video number 2 in the 3 video series. Video 1 was a quick tour video just giving a brief overview of the spreadsheet. This video number 2 goes through the accounting principles that need to be understood in order to use the spreadsheet. And that's basically a set of ledgers and an associated income statement and balance sheet, which of course must balance. And then video number 3 is a longer detailed video explaining the operation of the spreadsheet in quite a bit of detail. And a number of examples are entered to demonstrate how the spreadsheet works. So to be clear, this spreadsheet is designed for small businesses with likely just a few shareholders, and the discussion of accounting principles in this video is going to be presented from that perspective. Okay, so let's go ahead with explaining the applicable accounting principles. We'll begin with the accounting equation. And there's many different ways to write the accounting equation, but I find it most helpful to write it in this manner, as shown on the page over here. And this is a good way to write it because most people understand what assets and liabilities are. So assets are basically the good stuff. The more assets a business has, the better. So cash in the bank, for example, is an asset. Liabilities are the bad stuff, I guess. That's when the business owes money to others. And the good stuff minus the bad stuff is the amount of value in the business, which is the shareholder equity. And it's important to keep in mind that shareholder equity will not always be a positive number. If the business has more liabilities than it does have assets, then shareholder equity can be a negative number. But certainly it's helpful to think of shareholder equity as the net goodness left in the business after completion of operations for a certain period of time. Now, because shareholders typically pay some amount for their shares when incorporating a company, shareholder equity can be viewed as being made up of two things: shareholder capital and retained earnings. So shareholder capital is the initial investment that's made in the business by the shareholders when beginning operations, and it's often a small dollar amount, especially for small corporations with just a couple of shareholders. Those are typically not funded by large capital contributions, but normally there's a small shareholder capital amount, perhaps even just $1 that the shares will be purchased for, and then often the shareholders will put money into the business by way of interest-free shareholder loans. So that's not always the way that companies are set up. Some companies are funded through large shareholder capital contributions, but for now let's just assume a corporation with just one shareholder who pays just $1 for his shares and finances the business through shareholder loans that'll be repaid when the business has the ability to repay them. So in that case, we've substituted the shareholder capital amount on the right-hand side of the accounting equation over here with the $1 amount, and then the retained earnings is the remaining portion of the shareholder equity. So let's assume that for many years the business continues operating with just a single shareholder who contributed just the $1 for shareholder capital, and that there are no changes in shareholder capital in the years following. And that's actually not an uncommon situation, and it allows us to simplify and better understand the other parts of the accounting equation as we continue through this. Keep in mind, though, that when that shareholder contributes the $1, it will sit in the company bank account, and we can actually take a look at the accounting equation to show how it does balance even after that very first transaction has occurred. So the $1 goes into the bank account, and therefore assets will increase by $1. And as well, the shareholder capital amount is going to increase by $1, as we mentioned before. But we see that there's now $1 on either side of the equal sign, and therefore the accounting equation does balance. But as we go through this, we'll just refer to the accounting equation, and we'll have the $1 shown there, but we'll actually cross it out because we won't consider it much more. We'll just assume that shareholder capital is static, and we'll discuss the accounting equation and the changes that happen to it, separate and apart from the shareholder capital amount. Next, we'll consider retained earnings on the right-hand side over here. So retained earnings can be thought of as the cumulative net profit since the start of the business, minus the dividends that have been paid out to shareholders. So from time to time, as the business has unused cash sitting on its books, it may choose to pay that money out to shareholders in the way of shareholder dividends. But for now, let's assume that the retained earnings are just cumulative net profit and proceed on the basis that no shareholder dividends have yet been declared as the business has been operating. And let's break this down a little bit and just go through each of the different components we have right now. Consider that in the first year of business, the business incurs some liabilities with the hope of making a profit. So that might be taking on those interest-free shareholder loans that we spoke about before, but that would nevertheless be a liability that the business owes. The business might also borrow money from the bank and might also buy goods on credit. So for example, if you're running a construction business, you might buy some building materials on credit. So to start with, for sure, the business is going to incur some liabilities. Then, hopefully the business makes some sales and gets some money coming in the door and puts that money in the bank account, and that is an asset account. So now the business has some assets, and one can subtract the liabilities from the assets to determine the net profit for the year. And most people will find that quite intuitive. In other words, the amount of cash and assets you've accumulated minus the liabilities you incurred in order to secure that wealth will be the net profit for the first year of your operations. Now, if we put this back into accounting speak, we should say that it is not just the net profit, but it's the retained earnings at the end of the first year will in fact match the net profit at the end of the first year. And then hopefully in year number 2, the business will take in some more cash. It'll probably also incur some more liabilities, but hopefully the business will make a net profit again in year number 2. The net profit from the second year will be added to the first year, and we'll now have total assets after 2 years minus the total accumulated liabilities, ignoring the ones, of course, that have been paid down in the interim. But at the end of the second year, assets minus liabilities will now be cumulative net profit. And as mentioned a moment ago, if we're putting aside the dividend issue, cumulative net profit is essentially the same thing as retained earnings. Now we should keep in mind that cumulative net profit might actually be negative, in which case it would be referred to as a cumulative net loss. But it's not necessarily the case that assets will be greater than liabilities, but rather if the business incurs a whole lot of expenses and brings in relatively minimal income, then it will be in a net loss situation and retained earnings can be negative. So as we go through this, we're going to assume that the business is profitable just to keep things simple, but keep in mind that that's not always the situation, of course. Alright, so that's a theoretical explanation of the accounting equation, but how does it break down on a practical level when entering data in the books of the business? Well, in order to understand how it plays out in practice, one has to consider that there are certain accounting ledgers which underlie each of the assets, the liabilities, and the retained earnings sections of the accounting equation. So here's a table which I will use to list out various ledgers in the different sections. So given that we've been speaking about retained earnings as being cumulative net profit, we can actually break out the retained earnings section into income accounts and expense accounts, because indeed it's income minus expenses for each particular year that gives you your net profit for the year, and then as we mentioned, the cumulative net profit is the retained earnings. And then we should also add in a shareholder capital section, because recall the $1 that we mentioned was contributed to the business by the shareholders at the outset, needs to be recorded in that section. And let's go ahead and put in a divider line, which is directly under the equal sign on the accounting equation, just so we can be clear about which accounts are going to be on which side of the accounting equation. So now I'll go through the different columns we've got here and explain the different accounts that might appear in each section. So starting with the asset section, typical accounts that might appear in the asset sections would be cash in the bank, prepaid expenses, and accounts receivable. Now, to be clear, each business is going to have its own set of ledgers or accounts which suit its particular operations. Most businesses will have a bank account, for example. Many businesses will have accounts receivable. Some might have equipment, but the particular accounts that are going to be used is going to depend on your business, and generating and designing the list of accounts is a very important part of setting up your books when you begin to do your accounting. Okay, so next, in the liabilities column, you might have accounts such as shareholder loan, that's the interest-free shareholder loan we mentioned earlier, credit card debt, taxes payable, or regular accounts payable for goods bought on credit are all different types of accounts that you may have in the liabilities section. In the shareholder capital section, you'll typically have the amounts contributed by the shareholders, and in our situation we said that's just going to be a $1 amount that was contributed by the shareholder at the beginning of operations. Then for income, you might have revenue from sales as the main form of income from the business, And then finally, for expenses, you might have things such as rent, advertising, raw materials, cell phone, bank fees, and salaries. Again, these are going to depend on the individual reality of the expenses your business incurs. So now that we've listed some of the accounts that our business might use, we can look at the accounting equation and we can see how certain transactions might involve entries being made on opposite sides of the equal sign, which, as indicated earlier, we've replaced with this big red bar. So consider, for example, if a cash sale is made. Well, if you sell some goods or services for cash, you will then get some cash that'll add to your bank account, so your assets will increase, and as well your revenue from sales will go up. So there you'll have an equal amount being added on either side of the equal sign, and indeed the accounting equation will still balance. Another example might be if you buy some raw materials. So in that case, cash in the bank might decrease if you buy the raw materials for cash, and at the same time the raw materials expense will increase. Now you might think, well, we've got a decrease on the left hand side and we've got an increase on the right hand side. That can't be right. Well, it's important to keep in mind that income and expenses are looked at together to get the net profit. So if expenses go up, then income minus expenses is going to go down, and overall you're going to have a decrease on the right hand side of the equation, which matches the decrease in assets that happened on the left hand side of the equation when you went out and bought the raw materials. But it's important to keep in mind that you don't always need to have the two entries being entered as part of the double entry to be entered on on opposite sides of the accounting equation like we saw a moment ago. You can have situations where both entries in the double entry process happen on one side of the accounting equation. So consider, for example, if you go and borrow some money from the bank. Well, then the liabilities will go up because you now owe that debt to the bank. But when the bank physically hands you cash, you'll probably store it in your bank account. So you'll have an increase in assets, being cash in bank account, but you'll also have an increase in liabilities, perhaps on your line of credit that you owe to the bank. So part of the challenge with bookkeeping and entering data into ledgers is knowing which ledgers get affected. And it's with that concern in mind, which a lot of new business owners sometimes struggle with, that the spreadsheet actually has built-in macros, which will give you some feedback as to whether or not the entries you have made balance. So it's not 100% foolproof. It may still give positive feedback when there's an error, because it is possible to invent mistakes which still result in the accounting equation balancing, even though the entries aren't necessarily rational. But at least the spreadsheet has some checks that it does and gives feedback to the user to let the user know whether what has been entered makes sense or not in terms of balancing the accounting equation. But one thing that would also have become clear in the last couple of minutes is whenever you enter an item into the books of the business, double entry accounting says you must enter it twice. You never only enter an amount in one ledger. You always enter it in two ledgers. And as we saw, those two ledgers might be on opposite sides of the equal sign, or they may be on the same side. But always you must enter them in two. One will be a debit, one will be a credit, such that in total debits always equal credits, and they must always result in the accounting equation balancing. And we'll get into that in a bit more detail in the next couple of minutes. So let's now come back for a minute to the concept of retained earnings. And a little bit earlier we discussed retained earnings were essentially the cumulative net profit that had amassed over the past number of years. But when the business takes money out of that fund of retained earnings and distributes it to shareholders, typically in the way of a shareholder dividend, then retained earnings will decrease. So in fact, it's useful to think of retained earnings in a very literal sense. They are the earnings that the company has retained as opposed to having paid out. So over time, it'll accumulate a pot of money. Then from time to time, it'll issue dividends to shareholders, and the retained earnings are the cash left over in the business that has not yet been distributed to shareholders. As I said, typically by retained earnings, although sometimes management fee bonuses and things like that are a different way to get free money out of the corporation. And so retained earnings might also be decreased in that manner. And that essentially involves pushing up expenses, which is salaries. So retained earnings, as I mentioned, are not just cumulative net profit, but in fact is cumulative net profit less amounts that have been paid out to shareholders by way of shareholder dividends. So what I'm actually going to do is break up the right end of the table over here and put a separate retained earnings column over here, which is essentially a retained earnings account. So every year you do income minus expenses to get the net profit for the year. That amount comes across into the retained earnings account. Then, if dividends are paid out, the retained earnings account will decrease. And each year the income and expense accounts will be set to 0, and for that subsequent year there will be more income received, more expenses incurred, and at the end of the year there'll be a net profit for that subsequent year, and again the process will repeat itself and the net profit for the year will be taken to the retained earnings account. And in fact, because that's a process that repeats itself year over year, it's helpful to think of a separation between the calculation of net profit and the remainder of the accounting equation on the left-hand side over here. So I'm going to put a dividing line in there to push income and expense accounts off to the right. And in fact, what we've now got is the income statement, which is used to calculate the net profit, and then the balance sheet, which has the assets, the liabilities, the shareholder capital, and the retained earnings, which of course must balance. And in fact, what you'll notice now, if you keep in mind what we saw on slide number 3, was that the left-hand side over here, the balance sheet, in other words, assets minus liabilities equals shareholder capital plus retained earnings, that's exactly what we had on slide number 3. So we've basically just gone through the process to break down and explain how the accounting equation is formed, and we now see that the balance sheet contains the accounting equation and the income statement is where the net profit is calculated. And in fact, because the net profit is calculated on the income statement, which is then added to the balance sheet, it's better to move the income statement off to the left-hand side, confirming that it is basically a calculation that happens first, with the retained or the net profit for the year being carried over to the retained earnings account over here on the right-hand side. So that is an overview of the accounting equation and how the data in the income statement is added to the balance sheet to determine if the balance sheet balances. And as explained in detail in video number 3, the spreadsheet basically automates this process. It involves the user entering transactions into mostly the income and expense accounts, but also the asset and liability accounts, and then the net profit is calculated and pushed to a balance sheet, and it is checked whether the balance sheet balances. And what I think is a valuable feature of the spreadsheet is it does this very quickly and allows the user to check after each new transaction is entered whether or not the balance sheet still balances, which is, I say, valuable as compared to a situation where a whole lot of data is entered in a bunch of accounts, then the balance sheet doesn't balance, and there's a mass of data that's been entered. It's not clear where the mistake is, and it's very difficult to go back and find where the problems are. So what the spreadsheet does is it allows users to enter a single transaction, or maybe just a couple of transactions, and then very quickly run a couple of macros to see whether the balance sheet balances. And if it does, then that's fine. Keep going and enter some more data. And if it doesn't, at least you know that there's only a couple of transactions that have been entered since it did last balance, and therefore it's going to be easier to find where the mistakes are that are causing it not to balance. Alright, so I mentioned a little while ago that a tricky part of bookkeeping can be figuring out which ledgers data needs to be entered into. So let's go ahead and discuss the rules for entering data into ledgers. Under the double entry accounting method, all transactions are double entered, meaning that the amount processed by the business must be entered into 2 ledgers, and as I mentioned briefly before, this allows for checking of all data into the ledgers by making sure that debits tally credits, because whenever a double entry is done, there's one of them must be a debit entry and one of them must be a credit entry. So one unfortunate reality is that there can be no simple rule that debit is increase and credit is decrease, or vice versa. Rather, because we saw earlier that sometimes a transaction will impact ledgers on the same side of the equal sign, whereas in other cases there'll be transactions on opposite side of the equal sign, there needs to be a set of rules that debit and credit mean either increase or decrease depending on what account the entry is being made in. So for example, for an asset account, a increase is recorded as a debit and a decrease is recorded as a credit. For income accounts, a debit indicates a decrease and a credit indicates an increase. So I'll just go ahead and add in all of the rules that apply, and at the beginning, it's actually helpful to just memorize them or have a cheat sheet written down in a handy place so you can refer to it. But even though it can be somewhat difficult to remember them to begin with, keep in mind that they are necessary because we want our balance sheet to balance, and we also want all debits and credits to tally so that we can check that we've been entering data into the books correctly. And I can also confirm that in the spreadsheet, there is a list of accounts that is included on the second tab, which is called the Ledger Index tab. And at the top, it has some notes, which essentially are the cheat sheet that'll help you look up whether an account has a debit as an increase or decrease. And here they are. So balance sheet accounts, which are the assets, have a debit increase and a credit decrease. Balance sheet accounts, which are liabilities and equity, have a debit decrease and a credit increase. And the profit and loss accounts, if it's an expense account, it's debit increase and credit decrease. And if it's an income account, then it's debit decrease and credit increase. So again, you won't remember all of those the first time you hear them, but know that on the Ledger Index tab of the spreadsheet, you can go and look at the notes at the top to remind yourself whether a debit or a credit is an increase. Okay, so we're almost at the end here, and I'll just go over a couple of additional points. You may have heard of people referring to T accounts, and that is a reference to basically the T shape that you see I've got drawn on the page here. Then on the left-hand side, the word debit is stated, and then on the right-hand side, it's credit. So people often draw these T accounts out one below the other. They'll typically also write on the top left the name of the T account. So for example, it might be the bank account, and below they may have the other account that gets impacted, perhaps income from sales, and then they just write down the number on the bank account, whether it's a debit or a credit, perhaps having the cheat sheet on hand to make sure that they put it on the correct side, and then they enter the corresponding amount in the T account below for the other half of the transaction, just to as a quick set of working papers to figure out if the debits and credits do enter for the transaction. So certainly you might want to do that to help figure out where an account should be entered, but keep in mind that the spreadsheet does have some macros that'll give you some feedback, basically with a modified T account display form, which will show the debits and the credits on the different sides and actually give feedback as to whether or not the debits and credits do balance for the particular transaction. And then I should also just mention the difference between accrual accounting and cash accounting. So these are basically two different accounting methods, and the fundamental question to consider when understanding the difference between them is, when does the business record the transaction? Only when the money actually changes hands, or is it recorded when the obligation to pay arises? So consider, for example, if a business provides goods or services, and imagine that they do not get paid until 30 days after the goods and the invoice is delivered. In that situation, do they record the sale as having taken place when the material is delivered because they expect that they're going to get paid in the future and they want their books and records to reflect the fact that they were successful in making a sale? Or do you wait until the money actually comes in before you go ahead and enter the data in the books of the business? Well, under accrual accounting, it's the first method, where, as noted here, revenues and expenses are recorded when they are incurred, regardless of when the cash is exchanged. The same is true for expenses. If you receive a bunch of raw materials, but you don't have to pay for them until 60 days from the day you receive them, do you enter it as an expense on the day you receive them, or do you wait until you actually have to pay for the materials in 60 days' time before you enter the data in the books of the business? So accrual accounting does it when the expense or income is incurred, and cash accounting only enters the data when the money actually changes hands. The accrual method is generally more popular because it gives a more realistic idea of income and expenses during a period of time, and also in some jurisdictions the tax laws require that the accrual method be used for certain businesses. Alright, so that's the end of this basic explanation of double entry accounting. So don't forget to watch video number 3 for the detailed overview of how the spreadsheet works. And in fact, because video number 3 goes through a number of accounting transactions and shows how they're entered in the books of the business, that's very helpful for reinforcing the accounting principles that have been discussed in this video. Alright, I think that's it for video number 2, and hopefully you found it useful. Thanks. Bye.